Imagine a world where the Canadian dollar is on the brink of a significant shift, and investors are holding their breath as they await the next move from the Bank of Canada. But here's where it gets interesting. The latest Canadian inflation data has raised the odds of a rate cut, sending shockwaves through the market. The USD CAD pair is currently trading flat near 1.3870 in the early Asian session on Thursday, with the Canadian dollar steadying against the US dollar near an earlier 3-month low. This comes as the preliminary reading of the US SP Global Purchasing Managers Index, PMI, reports is set to be released later on Thursday, which could provide further insight into the state of the economy. According to the minutes of the Federal Open Market Committee's FOMC, July 29 through 30th meeting, most Federal Reserve, Fed, officials highlighted the risk to inflation as outweighing concerns over the labor market, as tariffs fueled a growing divide among Fed policymakers. Almost all participants viewed it as appropriate to maintain the benchmark interest rate in the 4.25% to 4.50% range, noting that it would take time to have more clarity on the magnitude and persistence of higher tariffs' effects on inflation. Traders are now eagerly awaiting the Fed's annual Jackson Hole Symposium later on Friday for clues on the U.S. interest rate path. If Fed Chair Jerome Powell leans dovish on interest rates, this might drag the USD lower against the CAD in the near term. But what's really driving the Canadian dollar? The key factors include the level of interest rates set by the Bank of Canada, BoC, the price of oil, Canada's largest export, the health of its economy, inflation, and the trade balance. Other factors include market sentiment, whether investors are taking on more risky assets, risk on, or seeking safe havens, risk off, with risk on being CAD positive. As its largest trading partner, the health of the U.S. economy is also a key factor influencing the Canadian dollar. The Bank of Canada has a significant influence on the Canadian dollar by setting the level of interest rates that banks can lend to one another, which in turn influences the level of interest rates for everyone. The main goal of the BoC is to maintain inflation at 1 to 3% by adjusting interest rates up or down. Relatively higher interest rates tend to be positive for the CAD. The Bank of Canada can also use quantitative easing and tightening to influence credit conditions, with the former CAD negative and the latter CAD positive. And this is the part most people miss. The price of oil is a key factor impacting the value of the Canadian dollar. Petroleum is Canada's biggest export, so oil price tends to have an immediate impact on the CAD value. Generally, if oil price rises, CAD also goes up, as aggregate demand for the currency increases. The opposite is the case if the price of oil falls. Higher oil prices also tend to result in a greater likelihood of a positive trade balance, which is also supportive of the CAD. While inflation had always traditionally been thought of as a negative factor for a currency since it lowers the value of money, the opposite has actually been the case in modern times with the relaxation of cross-border capital controls. Higher inflation tends to lead central banks to put up interest rates, which attracts more capital inflows from global investors seeking a lucrative place to keep their money. This increases demand for the local currency, which in Canada's case is the Canadian dollar. Macroeconomic data releases gauge the health of the economy and can have an impact on the Canadian dollar. Indicators such as GDP, manufacturing and services PMIs, employment, and consumer sentiment surveys can all influence the direction of the CAD. A strong economy is good for the Canadian dollar. Not only does it attract more foreign investment, but it may also encourage the Bank of Canada to put up interest rates, leading to a stronger currency. If economic data is weak, however, the CAD is likely to fall. So, what's next for the Canadian dollar? Will the Bank of Canada cut interest rates, and if so, what will be the impact on the currency? One thing is certain, the upcoming Fed Symposium and the release of the US SP Global Purchasing Managers Index PMI reports will be closely watched by investors and could potentially spark a significant shift in the market. But here's the question. Do you think the Bank of Canada will cut interest rates, and how do you think it will affect the Canadian dollar? Share your thoughts in the comments below. It's also important to note that investing in open markets involves a great deal of risk, including the loss of all or a portion of your investment, as well as emotional distress. all risks, losses, and costs associated with investing, including total loss of principal, are your responsibility. The views and opinions expressed in this article are those of the authors and do not necessarily reflect the official policy or position of FX Street nor its advertisers. The author will not be held responsible for information that is found at the end of links posted on this page. FX Street and the author do not provide personalized recommendations. The author makes no representations as to the accuracy, completeness, or suitability of this information. FX Street and the author will not be liable for any errors, omissions, or any losses, injuries, or damages arising from this information and its display or use. Errors and omissions accepted. The author and FX Street are not registered investment advisors, and nothing in this article is intended to be investment advice.